I love reading, always have. I even read about things that I might not necessarily agree with because I believe in staying open-minded. And I encourage you to do the same. Read and form your own opinions. Don't just listen to your buddy who might have a vested interest in selling you something. Instead, take the time to read and develop your own informed opinions. Now, in the context of this video, I've always thought that whole life insurance and the whole idea of infinite banking are meant for a very specific group of people. And most people should just stay away from these policies. Despite that, I've been told at multiple occasions to read the book, What Would the Rockefellers Do? It is a New York Times bestseller, so I bought it. And keep in mind, this is not the first book that I've read on this topic. It's actually the fourth one, including Becoming Your Own Bank by Nelson Nash. Anyhow, I have added this book to my collection of personal finance reads, and this is what I honestly think. In the simplest terms, the book talks about infinite banking concept, or IBC for short, and it is essentially using a specially designed whole life insurance policy as a tool for personal banking. The idea is to build up enough cash value within the insurance policy over time and then borrow against the cash value to finance various expenses, investments, or purchases instead of going to a traditional bank. People who support this idea argue that it offers individuals more control over their finances as they become their own bank and can use the policy's cash value for loans instead of relying on traditional banks. So instead of going to the bank for a loan, you become your own bank. It's a bit oversimplified, but that's the basic idea of infinite banking. And these policies are often compared to 401ks and your IRAs, where you have to wait until you're 59 and a half years old before you can pull that money out, whereas these policies, you have more control over your money where it's readily available. Now, right off the bat, and before diving into too many details, let me tell you what bothers me most about these policies and people promoting them. Almost everyone selling these policies claim that it's a super secret method to get rich that only the wealthy are aware of. First of all, that is not true. It is a very old concept, and it's just getting more attention these days because of TikTok. And thanks to TikTok, you might have come across the comparison of Rockefellers and the Vanderbilts. The Rockefellers were, and still are, wealthy because, well, you probably guessed it, they use these policies, whereas the Vanderbilts are broke because they didn't use these policies. If you've heard this story, it is true, and it is from the pages of this book. So whoever told you this story probably has read this book as well. Anyway, for the sake of keeping an open mind, the real question we should be asking ourselves is, does it make financial sense? Let's forget about TikTok and the people selling it and whether it's a new concept or an old one. Let's put all that aside. Does it make financial sense? One of the perks of using these policies and becoming your own bank is that getting a loan using the cash value in your policy is much easier than going to a traditional bank. The money in your policy is easily accessible and you're not forced to pay it back by a certain date, unlike traditional loans. And as this book mentioned, and correctly so, you can even choose not to pay the loan back. However, if you choose not to repay it, the insurance company will subtract the borrowed amount from the death benefit, reducing what your beneficiaries receive when you pass away. All this is great, but when you become your own bank and borrow money from the cash value that you have accumulated, you are still paying interest on that borrowed money. Typically, this interest is a little less than going to a traditional bank, but you are not borrowing for free. There is still interest to pay on the borrowed money. So let's say someone buys a whole life policy and they pay $15,000 in annual premiums. After 5 years, the policy's cash value might be around, let's say, $100,000, just as an example. Now, the policyholder can take a loan against the entire cash value and getting $100,000 to invest in something like, let's say, real estate. So while the cash value of the insurance policy keeps growing, the loan does not affect it. But here's the catch. The policyholder not only needs to cover the mortgage on the investment property, but they also have to pay interest on the loan from the policy. Basically, borrowing from the cash value of your whole life insurance is not free money. Moreover, infinite banking comes with a hefty price tag. Take, for instance, a 40-year-old man who is in good health. To secure a $500,000 whole life policy, he might need to shell out around $7,500 every year. The important thing here is that the annual premium payment is likely to continue throughout his lifetime. But the financial responsibilities don't end there. To make infinite banking effective, policyholders must go beyond paying the $7,500 annual premium. For someone like this 40-year-old man in good health, this involves contributing extra money to the cash value or overfunding your policy as talked about in this book. Next, the fees. If you've heard about infinite banking, chances are it was brought up by someone selling insurance. They usually promote the idea while downplaying the fees involved. In this book, there's a whole chapter criticizing Dave Ramsey and Suze Orman. Instead of that, I think there should be a whole chapter explaining all the fees involved and the breakdown of all the fees, like premium expense charges, per unit charges, monthly policy fee, the cost of insurance, and more. Explain how these fees are structured so people have a better understanding. It's almost left out intentionally. And perhaps the biggest drawback, at least in my opinion, is the time factor. It could take several years or even decades to accumulate the necessary cash value to begin taking out loans without incurring penalties. So you can't just start a policy today and start borrowing from it. You have to accumulate enough cash value. Now, people selling these policies often compare these policies to 401ks and your IRAs and the regular brokerage accounts. While many are aware that you can borrow against a whole life policy, what some may not know is that 401k accounts often provide a loan option as well. This allows you to access part of your retirement funds early without facing penalties and taxes. Additionally, taxable brokerage accounts offer margin loans as well. It's a similar concept of borrowing against a universal life contract. However, with margin loans, you can borrow against your brokerage account balances and keep your assets invested. It's similar, but not exactly the same because of one key difference. Life contracts don't face the same risk of margin calls as margin loans do. A margin call can occur if your investment balances decrease significantly, requiring you to repay your margin loan unexpectedly. So, the question is, does infinite banking make financial sense, or is it a scam? I am not going to say that it's a scam. I've said it multiple times that these policies only cater to a specific population, a very small niche. Whole life insurance is good if you've already built your wealth and you want to safeguard it. Whole life can also be a good idea if you want to reduce your estate taxes after you have maxed out your investment accounts like 401ks and your Roth IRAs. For most people, however, especially those starting their careers or their families, other investment strategies might be a better fit. Cash value life insurance is suitable only for few individuals. In many cases, term life insurance is more beneficial, particularly for young families needing a lot of coverage. Remember, unless you have $2 or $3 million ready to invest in a whole life policy all at once, you cannot immediately be your own bank, as the idea of infinite banking suggests. As someone had commented on my Facebook page, think of life insurance cash value like equity in your house. Just like building equity in your house through mortgage payments, the cash value or equity in your whole life insurance policy begins at zero and increases gradually over time. So infinite banking is not a shortcut to get rich quick despite of what you might see on TikTok. These policies are very costly, and to reap the full benefits of whole life policy, you'll need to pay a monthly bill of a few $100s. If you don't keep up with the payments, your policy will likely end. As an example, when you put money in a Roth IRA, you can put maybe $6,500 this year, $7,000 next year, and so on. But if something unexpected happens, like losing a job, you can decide not to put money and your savings will still grow. You don't have that luxury here. If you stop making payments, you are at the risk of your policy lapsing. If you want my advice, I recommend getting term insurance and investing the difference. That's what I do, and I wouldn't change that.